It was not a great situation at that point of time. I was a very stable job, very good job, high paying job. Leaving that thing and coming to the business, which is a lot of uncertainty.
If you look at it, let's say from last Diwali to this Diwali, I believe we are sitting at what? Roughly 0% returns. It has been more or
Minus.
less. On the other hand, if you look at some of the other asset classes, international equity, that has done phenomenally well.
But if the earnings are not supporting for a very long period of time, then obviously market cannot sustain that. So what is the earnings of Nifty in last 1 year is approximately 4%. There is a no chance that market is going to have a bull run to be continued.
What are some of the most common goals that you have seen in your investors?
Suppose I made a plan that I will live up to 75 years and I will spend all my money. What if I live up to 90 years? What if I live up to 95 years? Because I cannot kill myself. And when you that could depend upon your children or depend upon someone, it's very, very negative.
Do you believe that, let's say, gold has a brighter future because it is coming from with some sort of a momentum? Or you would be heavier on Indian equities right now because they haven't done well, then means the probability of them doing well later is perhaps slightly higher or something. So, would really like to know your thoughts around the various asset classes considering the market situation. Hi everyone, welcome to Desi Fire Podcast. I'm your host Ravi Handa. On this channel, we talk about personal finance, early retirement, and financial independence. And in a journey to discuss stuff with us, today we have Soumya Sarkar with us, who is the founder of Wealth Redefined. So let me just start with that, Soumya. Can you tell me and our users a little bit about Wealth Redefined?
Thank you for introduction, Mr. Handa. It's my pleasure to talk to you about the Wealth Redefined. We started Wealth Redefined in 2014 after my stint with global banks like HSBC and Standard Chartered. And currently, we are managing approximately around 600 crore of AUM of mutual funds. Mostly, we are managing the clients Delhi NCR as we are located in Noida. Also, we are managing the clients outside this Delhi NCR as well, like from Bombay, from Bangalore, Chennai, and some clients are international as well. We are mostly catered to the mutual funds. The primary product is mutual funds, but we do some kind of PMS and AIF as well. But majority of our clients are in mutual funds only. And we have a team of approximately right now around 25 people, which includes the research team, which includes the service team and the relationship managers. So this is how we have been journey, and it has been a good journey till now, thanks to market as well. But overall, yes, it has been a very interesting journey.
Fair. So let's say you quit HSBC and Stancy. These are fairly big brands. What was your financial situation like at that particular point of time? Because you have a stable career, a stable salary coming in, to jump to something like a business of your own. So did you have any sort of financial backing, or you were married at that point and your wife was working, so the expenses were taken care of? Tell me a little bit about that part of your life.
I would say it was not a great situation at that point of time. I was a very stable job, very good job, high paying job. Leaving that thing and coming to the business, which is a lot of uncertainty. It took a lot of courage and determination to go that way. But what actually worked for me is that the way I want put the things forward is that I took it as a quarterly basis. That if I can succeed in this quarter, then I will continue with the business. If I don't, then I will quit it and go back. So I have taken a stop loss kind of a thing in the business as well. That if it hits my stop loss, then obviously I will not go ahead. And first 3-4 years were a little bit difficult in terms of money coming in, trying to expand but not happening, not able to give good salaries to the people to attract good talent. So all those things has happened initially. COVID again had given a sleepless nights for us, that the market was falling, the AUM was coming down, clients were a bit irritated. But we did not give any kind of wrong advice or wrong thing. So clients stick to that. And after COVID, the market rallied and they also made money, and we also got good reference and good, you can say, remuneration in terms of.
I would try to understand what is your current outlook on the market, because what has happened is over the last 1 year, Indian equity has remained flat. It had a couple of, or rather 4 very good years before that, post COVID. But the last year, if you look at it, let's say from last Diwali to this Diwali, I believe we are sitting at what, roughly 0% returns. It has been more or
Minus.
less minus, maybe in some key indicators. On the other hand, if you look at some of the other asset classes, say for example, if you look at international equity, that has done phenomenally well in the last year or so, and again that has been doing well for quite some time now. Gold has done phenomenally well as an asset class in the last year or so, or rather I'll say for the last 3 years or 4 years, gold has been doing fairly well as well. Everything else has worked for the last few years, especially the last year, except Indian equity. Then, in this sort of a scenario, are you making any sort of asset allocation changes for your clients because of how these things are? And B, is there a particular asset class that you are favoring right now? That, let's say, suppose, do you believe that, let's say, gold has a brighter future because it is coming from with some sort of a momentum? Or you would be heavier on Indian equities right now because they haven't done well, then means the probability of them doing well later is perhaps slightly higher or something. So would really like to know your thoughts around the various asset classes considering the market situation.
Usually the investors always chase when the asset class is about to reach the top. Okay. They usually do not chase the asset classes which are actually undervalued to put money in. Okay. So what happened is that whatever news comes in, whether it is a Russia-Ukraine war or Israel, Iran or Israel, Hamas, or whatever is doing international everything, please understand the end of the day, the market wants earnings to come up. Because end of the day, whatever the sentiment is all a sentiment, it's all a news. But if the earnings are not supporting for a very long period of time, then obviously market cannot sustain that level. So what is the earnings of Nifty in last 1 year is approximately 4%. That is substantially low earnings. So definitely there is no chance that market is going to have a bull run to be continued. If the earnings did not come up, obviously market could not hold that kind of a rally for a very long period of time. And that is exactly happened in the last 1 year in the scenario. The money needs to be distributed somewhere or the other. So it started chasing the more of a gold kind of a product, because gold is considered to be a hedging product, not a investment product. It's a hedging product. Except 1 or 2 stocks which are trading at a very high price to earning, Nifty's forward fee is now on a very, very good shape. It's approximately around 19-20 kind of a thing. So if it comes to that thing and backed by our earnings, then I feel that Nifty is going to as a very good position to get into at this point of time. Okay.
Understood. So if I got the essence right, you do believe that there is a little bit of momentum which is still left in gold for it to continue for a few years, few months, maybe a year. For the Nifty part of it, or for the Indian equity part of it, I believe you are trying to exclude Zomato from it, because I have looked at the Zomato numbers. I think although the Nifty PE, whatever the number PE is at, Zomato is a very small contributor to the Nifty. I believe it's around 2% or something like that. But because it has a PE of 1,000 or something like that, it skews the entire ratio. So, which essentially translates to the idea that the Nifty PE is not as high if you look at the 98% of your investments. And it does look better than it looked, let's say, around a year ago, because the earnings have also gone up. So that becomes a decent bet.
We may see, because of this year, the India is a more of a rural economy. Okay. It's a lot of almost 60% comes from the rural economical background. So if you look at this year, monsoon had been very good. GST cut happened. Indian domestically, we are in a much sound place right now. Some international chaos is there, but domestically, we are at a very good place. We have a very good budget. Lot of excess cash has gone to the people. So if you see recently, after this monsoon has concluded, there is a lot of rural demand which is coming up. So obviously, the rural demand comes up, then you can see a good quarter, good earnings coming up in January, February, because October, November, December is a period when the festive season comes in, lot of new purchases, lot of new things happen. So you can see a good quarter comes up in January, January. And again, you can see a good quarter coming in January, February, March, because there will be budget and there will be year ending for the financial year. So if these two quarters do well, then obviously we can see a lot of earnings improvement. And government is also trying. You can see the GST cuts, up to 12 lakh rupees or tax free, 8th pay commission, all those things are coming up to boost the consumption. And now if you look at, we are moving out from a saving economy to a more of a consumption economy. So if that is also translated, which government is continuously trying, I think we can have a good rally. We can see a good earnings coming back to the market. And if the earnings come back, market will automatically start rallying.
Fair. I think, that is a very positive and a happy note, especially for folks like me who are invested heavily into the markets. But from an investor perspective, would you suggest to maybe go overweight on international equity right now, or the Indian equity and gold are your rather favored children at this point of time?
I would say Indian equity and gold would be my favorite. I am slightly cautious about the international equity at this point of time because right now the valuation of US market is almost not same. I think it is much more bigger than the before the 2008 crisis, the valuation of market, as well as before the Great Depression happened in 2029. So I think that I'm slightly cautious about the US market. But if you look at the China, I think that China has started only doing well since last 1 year after COVID. So I think that China still has a lot of potential. And we cannot rule out that China is one of the biggest manufacturers of the world. And we are all dependent on China to some extent about the raw materials, whether in terms of medicine or whether in terms of toys, whether in terms of anything. We can say electronics item and everything. So I don't think China can be ruled out. And I personally feel the last 4 years, China did not do anything anywhere. So if China can be favored, and I think I'm slightly favored on the China as of now. Japan, maybe I may be neutral because Japan has already rallied a lot. And if they go for another interest rate hike, I think it may not work out for them very well. But international equity, I'm slightly cautious in terms of US and Japan.
Fair. Now, let's say when it comes to India and talking about investing in India, you do recommend taking the mutual fund route. But even if you want to take the India story, can you give us a couple of fund names that we can look at to, take this thing forward that, okay, I buy your argument that India is essentially slightly favored, but I actually need to put money somewhere. I cannot say, okay, put my money in India. I would need, some funds or something that you would recommend at this stage. Let's say over the next 12 months, what sort of funds I should be putting my money into?
So a lot of people, what they do is that because of the last 2 years of small cap return, they blindly put the money in small cap without knowing that what would be the horizon, what would be the right way to invest. So I would rather say that if you are looking for a very long-term horizon, there is no harm of getting into a mid-cap or a small-cap fund. But if you have a horizon of, let's say, 2 years kind of a thing, you may take a bet on small-cap, but that would be a risky bet. I think better you take a bet of a multi-asset fund or a hybrid fund or a balanced advantage fund. That would give you a decent return without having a much impact on your capital.
Fair, fair. So, talking about investors, I'm sure you will have investors at various age groups, at various income levels. What are some of the most common goals that you have seen in your investors?
I think the most common goal, and which we also inspire the investors, is the retirement planning. Do you know, because see, for every other thing, you have a loan to cater your need. Suppose if you want to buy a car, you can get a loan. Suppose if you want to get a marriage, you can arrange a personal loan for yourself. But retirement is such a thing where you do not get any loans, and you're actually nobody gives a loan to a retiree. So that is the major challenge for anybody, and I think the first they should consider about the retirement planning. Because in India, we are not a very good at the retirement planning. Neither we have a direct help like a government, where government credit the amount or a big amount every month to all those things. Okay. So I would prefer that even if you have a insurance and everything, still you make a little bit of retirement planning, because if unexpected expenses come in because of any reason. So I would recommend you that please have a retirement planning very well, so that other needs can be catered. Other than, see, there are a lot of planning happen in terms of children education planning, marriage planning, and vacation planning, and all those things. But my primary focus always be on the clients that you should have a proper retirement planning. India, if you see Birla studies that happened, that almost 75% people do not have the proper planning of retirements and everything. So I think that is something which needs to be worked on and needs to be more focused. Though government has done up with NPS and all those things, but still it is a very, very nascent stage of doing it. We are not like US or any developed country in terms of that way. So we must be having that kind of planning first, so that wealth can be, suppose as a retiree, I can take care of my wealth, and I can pass it to my next generation as well, so that they do not find the difficulties in terms of their retirement as well. So I think that is the right way.
Can you take some examples of your client? Ideally, let's say someone who came to you a few years ago, was close to retirement, and is now continuing his retirement with you, and how you did the retirement planning in some examples that you can share?
Yes, I can share a couple of examples, but I will just share one example right now. Is that a person had come to me at around 51 kind of it, and he wanted to get retired by around 60, though that was not decided at that point of time. So immediately what I started is that I started immediately his SIPs. So a person with a 25 years of age, a 15,000 SIP is good enough to give a good amount in 60. But a person as a 51 year of age cannot go with a 15,000 SIP and make that kind of return. So I started with a big SIP, and slowly, gradually, what I initially did is that the client had supported me, is that he did not take out the money at that point of time. I convinced him that, sir, please do not take out the money, because suppose I'll tell you one thing. Let's say I'm investing 1 lakh rupees in SIP per month. Okay. So how much I'm investing? 12 lakh rupees in a year. Now let's say I have a sudden expenses come in. I took out 8 lakh rupees out of it. So that means I have completely killed my 8 months of SIP in one go. So ultimately I left with the 4 months of SIP on. People, when take out the money, they don't think in that way. So what I did for that client is that I said, do not take out the money, whatever you require at this point of time. At least break it down. So it started in 2013, and what happened is that because he's in a good position, so he used to get a lot of bonus, not a very big amount, but a decent bonus, 5 lakh, 10 lakhs, 15 lakhs on a quarterly basis. So I started putting that money also in equity. And that point of time, Indian equity was very undervalued. So I put the money into equities and everything, and started equity funds for his SIPs. And you won't believe, in 2020, his portfolio was something around approximately 2.5 crore kind of. And then this massive rally came in. And today his portfolio is sitting approximately 6.5, 7 crore kind of a portfolio. So that has taken away all his retirement concerns and everything. And today he's completely retired. He's doing his work, but he's doing the work for his own purpose. So he's not bound by someone to do the work. So that I have done it for him, and that had actually worked for him. So this has happened with lot of the clients. Some clients are extraordinarily savvy in terms of market. Some clients do trust us much than their own instinct, and they listen what we say. So I remember one client in COVID who intentionally came and said when the market was at the bottom and said put my all money there. I was a bit hesitant that whether it would fall further or not, but he was that kind of, and he put the money and he almost made a 4 times return of his the money which he put at that point of time. So this is a combination of the things. So a lot of clients have taken those kind of calls. Mostly I have seen that people who have done a SIPs on a continuous basis without disrupting it and without taking any money out of it just for sake of taking out, they have actually made a lot of money out of this thing and had a good retirement corpus from themselves.
Fair. So this was an example of someone who started and got to a higher corpus. Do you actually have, some clients who are actually withdrawing from the portfolio right now instead of investing in? So, because the investing part, the SIP part, I believe that a large number of users understand. It's the withdrawal part which worries a few people that, okay, how do I actually withdraw? Maybe an SWP works as the counter for the SIP, or are there other strategies that you recommend to your clients for people who are actually retired and withdrawing money from the portfolio?
Yes, we do that thing as well. So that is a concept called SWP, Systematic Withdrawal Plan. Usually we request clients that you should do a SWP rather than a one-time taking out the money, because SWP is a constant process where it's like taking out small every month, and bucket gets filled with the market movement every month. So that kind of way it works. So yes, we have a clients like when they build a good corpus, let's say a big corpus, we say that you should not withdraw more than 8% kind of a thing. But depending upon the situation, we withdraw the money, and we try to withdraw limited as per his needs rather than a constant give. Because see, what happens is that, let's say I have a portfolio which is running at a CAGR of 15%. And I emotionally take out the money by force from there and put it in my savings account. And what is the interest of savings account? Is 2.5%. So what happened is that I'm taking out from a 15% and putting the money in 2.5%. Okay, by force. That should not happen. So rather what you can do is that you can find that, okay, I have a minimum requirement of this month, this much every month. So I will take out this much every month. Additionally, I have certain money which is lying with me, which at my disposal to take out at any point of time. Let's say, I'll give you an example. Let's say I have a 5 crore portfolio and I have decided that I will take out 8%. So 8% at my disposal. So the thing is that how much it is 40 lakhs. But I don't require 3.5 lakh rupees every month. So what I do is that I take out 1 lakh rupee every month and 2.5 lakh I will keep it in the fund itself. If I had to go for a vacation, if I had to plan something, then I will take that amount so that my needs also can be catered, and I am not putting the money somewhere where it doesn't give me any return. So that both needs to be taken care of properly, so that I do not put the money in the wrong basket. I let my money go also. Plus, I am taking care of my needs as well.
So essentially, you are talking about withdrawing in 8% is.
I think it is fair. It is fair because every days are close to that thing. So you will never touch the. Usually, you do not touch the capital as such, because nobody wants to touch the capital as such.
I think that itself is a problem. Why should you not touch the capital, boss? The idea is, at the end of the day, you have earned this money and you have made this money for your retirement years. I understand that, okay, fine, I will need to leave something for my future generations. But I've heard this idea from many of my father's friends, many of my friends as well, that, okay, I'll have a corpus, whatever returns. So people do this with dividend investing, for example. I'll buy shares, whatever the dividend comes, I will live on the dividend, but I will not touch the principal shares. I've seen this argument, okay, fine, I have flats. What I will do is whatever the rent comes, and this is a very typical retiree thing that I have seen. I have an FD or I have a flat, whatever interest comes, whatever rental yield comes, I live on that, but I will not touch the principal. I personally don't like the idea because I don't want to leave such a large amount of money for my future generations and live only on that small 4%, 5% yield, whatever it is generating.
See, what happened is that suppose I made a plan that I will live up to 75 years and I will spend all my money up to that. Okay. What if I live up to 85 years? What if I live up to 90 years? What if I live up to 95 years? Because I cannot kill myself. Okay. So I will live that life and see at the 85, you may want to struggle even at 35, 45, 55, but you don't want to struggle at the age of 85 or 90. And when you that go to depend upon your children or depend upon someone, it's very, very negative because see, physically you start depending upon the children or physically you may start depending upon other people at that time. But obviously, financially also you do not want to depend upon them. So that is the reason what a lot of people do is that they don't want to touch the capital. They think that yes, let the capital be there. If any big emergency comes in, then I can use that. You do not know what kind of emergency comes in, what kind of capital they have. I have seen a lot of people who are such a disciplined life they lead. They are not getting into those kind of things where they can spend like a left, right and center. Because and you see the lot of clients I have seen, they build that kind of wealth because they are very disciplined. If they had not been disciplined, they could not have built that kind of wealth. So they have been disciplined and they suddenly will not change at the age of 65 or 75 or 85 and they will not start going to Las Vegas or something like that. Okay, so they with their age and everything, they become more matured and all those things. So the major expenses come for them is in terms of medicine, in terms of going to their children, spending time with the children, seeing some good things. But they are not going to casinos and play and lose all the monies. So that is it. See, I have in my clientele, I've seen that when they can't have that kind of money, they definitely like to spend the money, but they are not going to say. I have a lot of clients. I say that, sir, why don't you buy this kind of wealth? Why don't you buy a Rolls Royce or that kind of? He said that I don't require it anymore. I don't want to show it to anymore of that thing because that my age has gone all past all those things. So even they are creating that wealth, they are not spending that. And a lot of people also do a charity to the good thing because they find it that, okay, fine, I take out some money and give it to the society rather than keeping with my family and everything. So that is also one of the good things that.
Fair. Before we end today's very insightful discussion, I would like to take a specific use case because we all know that anything you talk about personal finance, we can talk about the generic that, okay, the markets are high or low or what gold will do. But it becomes a very personal question for a lot of people because my life and your life are going to be very different from each other. There is a 75-year-old gentleman. His wife has passed away. He received 60,000 rupees per month as a government pension, and his typical expenses are close to 30,000 rupees a month. So he's saving nearly half of his pension. He doesn't spend that much, probably like the client that you were talking about. He has very good health insurance because he was a central government employee. So the CGHS scheme is there. He owns the flat he lives in, has 50 lakh rupees in HDFC Ultra short-term fund to take care of emergencies and some other money that comes in. And he recently sold a property of 1.5 crore rupees. His goal with this 1.5 crore rupees is to leave inheritance for his heirs. How would you recommend that he invest or structure this 1.5 crore rupee money considering the other background that we have talked about?
So I believe, see, 50 lakhs rupees, and because he has a health insurance, which is being a government employee, 50 lakh rupees in ultra short is definitely going to be a good emergency fund he had created. Additionally, he's saving 40,000 rupees. So 13 to 12 is approximately 3,60,000 is anyway he's saving. Okay. Maybe that is maybe investing into let's say into fixed deposit or into any kind of bond funds or some kind of thing. So ultimately, you have said that he's 1.5 or whatever amount he has received. That money is for his heirs, not for him. So I would recommend that he should go for a equity funds with that money if he thinks it is for the heirs. If he thinks it is for him, definitely not equity fund because 75 is usually
No, it's for the
heirs
heirs.
only. So he should go for the equity funds. What kind of equity funds? Definitely not in one kind of go that everything could be on small cap or everything put on the mid cap. We should diversify it, diversify it properly into some kind of a hybrid kind of a fund, some fund into large cap, some definitely into mid cap and small cap, and some portion he may put into metals like gold kind of a product. Because what happened is that last couple of years we have seen sometimes gold have outperformed the equity market as well. Okay. And sometimes in last 10 years, it has given almost the same return of a equity market. So definitely that should be in the pocket. So if it is a 10 years kind of a thing, I think he should put some amount of money to metals like gold, some amount of money into a hybrid kind of a fund, some in large cap, some in mid and small cap. So that he's properly diversified, as well as you do not know how the emergency comes in. If some emergency comes in 2-3 years kind of a time, he can take out from the hybrid kind of a fund, which is a more of a capital safe kind of a thing. And because it is going to the heirs, so obviously he can put the money into equity funds.
I want to go one step further on this. Let's say he has decided that, okay, I will put in, say, 50% in a large cap fund, 25% in a small cap fund, 15% in a hybrid fund, and 10% in gold. Just random numbers that I am talking about. And I do believe that these numbers should be more or less on the right track because you would want larger portion in equity and lesser in gold and hybrid. But let's just assume with these numbers. How do you recommend that he actually put this in? He has identified the funds for it, but should it be done in one go? Or should there be that you do an STP, a systematic transfer plan, over a period of 3 months, or perhaps a systematic transfer plan over a period of 3 years, or no, forget all that, make a phone call tomorrow and put everything is tomorrow, because anyway you are diversifying, so it happens on day one, the better it is. What would you recommend for that part? How does he actually execute this?
So I would recommend it in this way. If it becomes my client, I will definitely have a clear talk with him. And see, depending upon the market valuations, if he puts the money when the valuation is at a right place and right thing, I think he can go for a one-time investment. But if the value is
Today,
in this point of time, I think some funds he can go for one time, but definitely on a mid cap and small cap kind of a thing, he should go on a staggered way, because if the valuation is not right, then obviously on staggered way would be a better. Sometimes a staggered way may not work, okay? But usually if he has an active advisor and everything, he may put it in a staggered way, let's say in 3 months or 6 months or 1 year of time, because nobody knows. And so let's say he has a staggered way of 12 months, but suddenly there is a fall in the market happened and the valuation comes right. So the active advisor will not going to wait, and he will put the money in one go. Because say, why would go for a staggered way? It's just for getting a better valuation, nothing else. Nobody wants to hold the money. The only thing is that because of the better valuation, that okay, I may get a cheaper. So on that expectation, people go on a staggered. So if he gets the valuation, let's say he has a plan to put the money in 12 months, but he get the right valuation and right opportunity at 3 months, he will put the money in 3 months. So that should be the right approach. It should not be on a very, you can say very static approach in that. You should have a dynamic approach that, yes, if I get the right valuation, I will go for it. If I don't get it, I will wait. I will wait for it to get into the right. Because see, once you go wrong, okay, then it's difficult to come back. The more you go on the wrong side, the U-turn become more difficult. So that is the thing which is there.
Fair. I think hopefully this hypothetical person will be able to invest in the funds at the right time. Thank you, Soumya. Thanks a lot for taking out the time and discussing all of these cases with us. I will definitely come to you if I have more questions. If our users have any questions for Soumya, please use the comment section. I'll try and pass them to Soumya and get his answers on those as well. Thank you for watching. Please remember to like, share, and subscribe.
Thank you.